All right, by my watch, I think that puts us right at 10 o'clock Central. So good morning, everyone. Or I guess good afternoon if you're coming from even further than out east. Appreciate you all joining us for our mid-year check-in. So I'm Brad Long, Managing Partner and Chief Investment Officer here at Fiducian Advisors. I am joined by my colleague, Rob Lowry, Principal and Associate Research Director. So we have 30 minutes on the clock. We got a lot to cover. So if you have questions, put them in the chat queue. We're happy to address them, and we'll try, frankly, to address them as we go throughout. We'll also leave it a little bit of time at the end for additional questions. And then, as always, if we don't get to your questions during this presentation, reach out to your consultant, reach out to us. We're happy to address them after this call. So each year we set our annual outlook. We put that and publish that in the beginning of the year. And then middle year, we take a check-in, right? It's a pulse check on what's going on in markets, in the economy, and asset classes, and are our portfolios still positioned for what we think to be optimal positioning of where we think the remainder of the year and frankly beyond will be driving prices and opportunities and risk. So we will get into it. We've got a lot to cover and kind of buckle up because we got a quick 30 minutes coming up here. So 2025, we came into the year with a handful of themes that we thought would be primarily driving prices and opportunities as we looked into the calendar year. The first was this idea of fragility. Fragility, the preconditions of that are full valuations here in the US, concentration, especially in US large cap, and the risk of reignition to inflation, potentially influencing prices and volatility. Now, we saw fragile markets in April of this year coming in with Liberation Day and a lot of the volatility that showed up. Usually markets are a bit more resilient to just news at any one given time, but clearly we almost entered into a bear market in a handful of days. As we sit here today, middle of the year, frankly, it looks a lot like how we started the year. We're back to all-time highs. We're back to full valuations. Maybe we're a skosh off historically high concentration, just a little bit under as some of the Mag 7 is pulled back, notably, Apple or Tesla. But still, markets are very concentrated in inflation. We had a CPI print for June coming out this morning at 2.7, a little hotter than A, what the Fed wanted, and B, maybe where expectations were. So we know that some of this is still coming down the pike. Now, the cure for the disease, right? If fragility is the disease, the cure is durability. And we'll talk about what that means. And, if you joined us in the beginning of the year, kind of how we positioned ahead of that. Intentionally around rate volatility within fixed income, our global equity allocation. How do we potentially address valuation concentration and inflation here in the US through asset allocation outside of the US? And then alternatives, which we'll get into in greater detail in a little bit, but is a good segue into one of our primary themes for the year. Our third and final theme is the age of alpha, right? So an opportunity with the preconditions of high valuations, materially concentrated indexes, and the risk of rising inflation, those sow the seeds for opportunity across both traditional stocks and bonds, asset classes, and non-traditional. Think of hyperactive things like hedge funds or even investment selection in private markets, which is a multi-year, if not decade-long investment creating opportunity in those spaces across active. So our themes as we started the year still very much remain entrenched in what we think is optimal portfolio and positioning, and we'll delve in the next 30 minutes through even more of that.
There have been no shortage of events this year so far, and dovetailing into those themes that Brad talked about, trade policy, deficits, geopolitical events, all contributing to market volatility so far in 2025. Concerns about inflation, growing deficit, uncertainty around monetary policy has created fixed income volatility, especially within interest rates. But overall, fixed income returns have been mid-single digits, pretty resilient. The standout on the page, international markets on the equity front, having one of the best starts to the year over the last 20 years, and we'll dive into this a little bit deeper later on. But relative to the S&P 500, up about 6% year to date, right? Less exposed to some of those Mag 7 names, technology, and the concentration risk that has created fragility within the US market. Diversifying segments, real assets, commodities, REITs have held up well also. Underlying commodity performance and geopolitical events creating volatility there has driven oil prices and other commodities higher and has supported those diversifying segments. If we zoom out to the broader economy, if we think about fragility in our asset class markets, we can also think about that in the context of the overall economy as well. There are definite signals being supportive, a strong labor market, somewhat supportive consumer spending and retail sales. But on the flip side, there are also some liabilities to the economic picture, lower confidence levels, lower optimism on the business side, growing deficits, et cetera. You can see in the middle of the page there, the Strategas Diffusion Index, right about in that messy neutral middle area. There are a lot of factors that could go either way, and there's a lot of uncertainty created in this environment with monetary policy, trade policy, et cetera, that could go shift things to the asset side or the liability side, but it's creating a decently unclear picture right now. If we explore this a little bit more, on the soft data side, so soft data being consumer surveys, small business surveys, confidence, et cetera, we saw a nice ramp up post-election in the fall, but since 2025 started, we've seen a pretty significant decline. A lot of that around growing concerns about inflation, what trade policy and tariffs will mean on the business front and for consumers, geopolitical events around the world, all creating uncertainty and pushing businesses and consumers to be cautious. Soft data often thought about as forward-looking, but it's painting a more negative picture than we started the year with. On the flip side, and conflicting that is the hard data, right? So think retail sales, think GDP, think unemployment rate and labor market numbers. The unemployment rate in the labor market has been pretty resilient. We added 147,000 jobs in June, a really strong and better than consensus estimate print. And the unemployment rate is held in there right around 4.1% over the last 12 months. So pretty steady. That's really supportive of the consumer. We had a negative GDP print in Q1, but despite that, expectations and consensus estimates are for a rebound in positive GDP in Q2. So we have this conflicting data between hard and soft. And a lot of that is just driven by the uncertainty in the market right now. And a lot of that uncertainty driven by trade policy and tariffs and what the impact will be there.
So speaking of tariffs and trade policy, right, we are still in the midst of I guess, the hangover of Liberation Day, right? We remain in limbo. In early April, it was, we announced reciprocal tariffs. Remember the Rose Garden and a big piece of, cardboard talking about the level of tariffs. And then pretty, not immediately, but just in a handful of days after, we put in a 90-day reprieve. We have surpassed the 90-day reprieve that has been extended to August 1st. To be honest, a 90-day period of time to resolve material discussions between countries on really a new world economic order, kind of post World War II order, was a bit Pollyanna to begin with. You can see, dark blue bars here is average across, historical country negotiations from launch to signing. Average takes about 18 months. All the way to implementation is 45 months. Now, remember, as investors, we don't need the implementation. We really just need the resolution because uncertainty has created, some of the dynamics that Rob was talking about, softening, soft or weakening soft data while we still have strong hard economic data. So here we sit with tariffs kind of in this limbo state. Now we do have a little bit more information than we had in early April, and I'll give you two examples that can help frame some of the context here. So first is the United States has inked a deal with the United Kingdom. That's actually a country where the United States has a rare trade positive balance with. And remember, that was a big part of the calculus in original trade reciprocal tariff rates. And so, we have inked a 10% tariff rate with the United Kingdom. Largely, you can think of that as a floor, right? It's hard to think that in an environment that we're going to be materially below that. Now, if you look at the bookend of that, Vietnam, we've inked a tariff deal with them at 20% plus an additional 40% on transshipped goods. So the effective rate is slightly higher. But given the fact that that Vietnam has a material trade deficit with the United States, that they have very close economic ties to China, you can think of Vietnam as kind of the other bookend here, right? Of a high level. Now, there's absolutely no guarantee that everything else is going to smash in between 10 and call it, 30% effective, but a 20% sticker price for Vietnam. But it does give us some sense of where the bookends may actually land as things start to come together. So, a lot of uncertainty still remaining here. We remain in limbo, and China is the notable exception here. We should say they've always been the exception in negotiations, and that's not a Trump 2.0; it's a Trump 1.0 from 2017, and that they kind of are on their own path. So I wouldn't put China in either of those bookends. Now, as we look back to how we positioned coming into the year, right, we had no idea that Liberation Day would show up on our doorstep on April 2nd or the markets would react the way that they would. But given the themes, fragility, durability, and the age of alpha, and some of the pre-context of how we entered the year, we positioned portfolios accordingly. With the potential for rate volatility, we did modify our fixed income positioning, adding more tips, age of alpha, right? The opportunity for dynamic bonds to outperform this market. Both of those positionings have been additive year to date. Rob mentioned the mountain chart, right, of international equity markets versus US equity markets year to date, and one of the best starts in multiple decades. We increased our relative overweight to international and emerging beginning of the year, and that's been additive thus far. And then across alternatives, right? A mix of remixing real assets, right? Whether inflation be driven by policy, by economic circumstances, or even geopolitical, right? We have Iran and Israel, and the potential for perhaps headline inflation to be moving up if we do see a material change in oil prices, all the way into alternatives, things like hedge funds or private markets, which we'll talk about in greater detail in a moment. But in short, how we came into the year, we feel still very well positioned in how portfolios kind of stand current market conditions, not just for the second half of 2025, but really beyond.
We think about our capital market assumptions, especially within the fixed income space, all in yield. So a combination of the risk-free rate and a credit spread is a really big determinant of expected future returns. And right now, despite moderating a little bit year to date, all in yields look really attractive across the fixed income landscape. Over the last 20 years, yields sit in the top quartile, top half across asset classes. A lot of that has been driven by higher interest rates. And on the flip side, credit spreads have been compressed or getting tighter. If we look at the credit spreads, they actually have a conflicting signal sitting closer to the bottom quartile, bottom 10th decile of the last 20th year or the last 20 years. Right? Those conflicting dynamics tell us a couple of things. One, it creates opportunities for active managers, especially within dynamic bonds. And as Brad just mentioned, right, having that dynamic bond position in portfolios to help create durability. And it's also created a more muted outlook for dedicated high yield. And while all-in yields are really attractive at 7% for high yield, the outlook going forward is not quite what it was a few years back.
So as we think about that outlook and we take into account both what Rob mentioned at the beginning, right, and where the economy sits today and even yields as we're talking about here, there's really two primary levers that we can pull on to drive the economy and drive markets. And that's fiscal and monetary policy. Today, it's pretty unquestionable that the executive branch and frankly the legislature, through the passing of OBBB, right? I think I got enough B's in there, have their foot on the economic gas pedal, right? They're seeking, really expansionary policies, extending or really making permanent the TGCA, the Tax Cuts and Job Act, so that eliminates a tax hike that would occur around $400 billion in January of next year. A number of incentives for onshoring and domestic manufacturing, really trying to put their foot on the gas pedal. Now, it does add to deficits, which we'll get into in a moment, talking about what's going to go on with long rates. But fiscal policy is off into the races. By contrast, monetary policy has their equivalent of their foot on the economic brake. Right? Policy is currently restrictive, and in our opinion, perhaps rightfully so, with policy uncertainty, with economic uncertainty, and the potential for rising inflation. in spite of a very stable and strong and full labor market, right? There's no reason that the Fed needs to come to defend labor when unemployment is where Rob was mentioning earlier. Yet, it's certainly no surprise that these two gentlemen have been in disagreement with one another, and their policies have reflected that. Which also draws a question, which has shown up a lot in questions with clients and also across media around Fed independence. With Donald Trump kind of pounding the table saying we need to lower rates. We should have done it, much earlier. We should do it very quickly. What does that mean for Fed independence? And while the Fed it's an imperfect institution, it always has been, it always will be. I would say that, kind of the death of independence perhaps has been overstated. So we want to jump into that just briefly and give a little bit of context. So those that don't live in the world of the FOMC, the Federal Open Markets Committee, it is a committee of 12 members. Now, while Jerome Powell, the chair, is the front-facing and most public version of that committee, it's not an autocracy. It is not Jerome Powell's interest rate policy, it's the FOMC's interest rate policy. Any change in interest rate policy takes a majority vote, which would be 7 members. Members are appointed, 7 of them are appointed by the president and confirmed by the Senate on a rotating basis, either based on availability or term expiration. So every president is guaranteed a minimum of 2 appointments to the Fed. The remaining governors come from the banking system. The head of the New York Fed is a permanent member. There are other operating or rotating members. Austin Goolsbee here in Chicago sits on the board this year. Next year, he'll rotate it off, and another individual in his region will come in. Right. So it is not simply just the chair. With Chairman Powell's term expiring as chair in May of next year, and actually Donald Trump reappointed him as chair in spite of his love loss for him recently. With a new chair and even new members, it does not mean that these columns, kind of the hot column of we should increase, neutral in the middle, and doves that we should decrease, all of a sudden the mass shifts, right? So you can't just stuff the board with a new chair. Now, while interest rate policy may change, it's likely to change. Frankly, our view is it's likely to go down in the not so distant future. It doesn't mean that because the Fed has lost its independence. So while it is an imperfect institution using imperfect information, just as we all are, trying to look through a foggy glass into the future, we don't think that it's lost its independence, which is an important, very long-term stabilizing factor for the U.S.
We know the Fed controls rates on the short end of the curve, that front end. But if we think about the uncertainty in the economic backdrop and where that might lead interest rates on the long end, it's not as clear a picture. Historically, the long end of the curve, right, that 30-year bond or 20-year bond, has been a really good hedge against slower economic growth. And as interest rates fall, it does really well. But a lot of the factors that drive that are secular, right? Deficits, inflation expectations, demand, growth, etc. And there's a lot of uncertainty right now. And yes, while the economy may slow, there's also could be a surprise to the upside or higher inflation. And interest rates may bump modestly higher on that long end of the curve. That risk reward dynamic on the long end isn't all that attractive. If we look at the chart here on the left, right, a 1% move lower in interest rates would be beneficial for bonds, right? Bond prices move higher as interest rates move lower. But on the flip side, if interest rates move higher, you can see that it has a pretty large drawdown potential on the long end. And it would only take a really small move, 30 basis points, to wipe out that current yield cushion offered today on the long end. However, we think more in the belly of the curve, right? Core fixed income presents a more compelling and balanced opportunity within the fixed income space and within portfolios to create that durability that Brad has talked about. Right? It provides a nice yield cushion, benefiting if interest rates move lower, but it also provides potential for opportunities in other environments as well. Should rates stay sideways, kind of stay consistent, constant, or if even rates tick up a little bit higher, there's current yield in the market to protect.
So as we think through scenarios, right, like rising or falling interest rates, we did want to punch into a couple of scenarios too on the fixed income side. So you've heard us say fragility, and the first word that we say following fragility is around valuation, right? So markets are fairly expensive. We want to unpack that for you a little bit and just say like, well, why does that cause fragility and what does it mean? So if we look at the S&P 500, and this is the example given here on the screen, in a simplistic sense, we can break it down, its price, into two primary components. It's earnings per share, which would be the x-axis here, and valuations, multiples, what we're willing to pay, which would be the y-axis. So earnings per share is the net economic benefit that a company, or in this instance, the index, creates. So a company sells a product, it creates revenue, it has costs of running the business, and ultimately it has earnings. And then it has a number of shares outstanding. And so earnings divided by those number of shares gives you that per share economic value it's creating. Then we as investors get to decide how much we're willing to pay for that, right? What's the multiple? What times we're willing to pay for that? And we're willing to pay more when animal spirits are high, when the opportunity for growth is high, and we believe that future opportunity is growing. Now, to orient with this chart, you take kind of current earnings per share, so where the S&P earnings per share is today, and you take the current valuation, so call it 22 times forward earnings. You'll see that number is zero. That makes sense. That's where the price of the index is today based on current circumstances. So if we were to move one box to the right of zero, and you see that 6%, if the S&P were to achieve consensus earnings growth, which is about 6% growth from here through the remainder of the year, and we as investors collectively are willing to pay the same valuation for those earnings, you can see there's about a 6% upside. If the S&P were to grow earnings at a rate that was actually more reflective of the last 10 years, closer to 8.5% earnings growth across the entire index, you can see that upside potential is even greater. Now, conversely, if we had current earnings today, and let's just say they were flat for the remainder of the year, but we move back to 10-year averages of valuations, right? Now our animal spirits are falling and we're less interested because earnings are not growing as much. You can see that box drops down to 10%. Now, reality likely lives somewhere in the mix of these. This is not prescriptive, but you can see there's a lot of red on this screen. Reason being is when you start with full valuations, it takes a lot to find upside potential. Either collectively valuations need to move higher, which is harder the higher they start, or you need to have upside surprise and growth and continued earnings. Conversely, right, more can go wrong at full valuations. That's one of the nodes of fragility, right, in starting at full valuations. And there's a whole host of things we can do to mitigate that potential risk. We talked about our global positioning, but it's also relative value, right? Fixed income versus equity, not just equity versus equity. We talked about this at the beginning of the year, right? The opportunity cost of, say, owning equity today versus fixed income. On a forecasted basis, remember, we build 10-year forward-looking capital market assumptions across asset classes. On a 10-year basis, we do believe that equities will outperform fixed income, and that's very common. Frankly, it's demanded. You wouldn't really want to take equity risk if you didn't think it outperformed fixed income. But the degree to which we expect it to outperform is fairly modest, less than 1%. And that's certainly less than historical averages. So on a risk-adjusted basis, fixed income is fairly attractive relative to equities. Now, this does not mean you go out, sell all your equities and buy, only bonds. And frankly, for current clients, this thinking and relative value and opportunity cost, this is already embedded in the portfolio. This is in allocations today. But for those that have been on autopilot, right, you've kind of enjoyed the ride of the equity markets. You've gone from a 60-40 portfolio to a 70-30 or an 80-20. It's a thoughtful time to pause and say, okay, with my current portfolio positioning, does that reconcile with A, the risk I want to take, and B, the opportunities that exist elsewhere across markets? We would say that the relative value, certainly across fixed income, is there today.
We've spoken a lot about fragility in the US markets and constructing durable portfolios. And let's unpack this a little bit more and just look at what has happened on the equity side year to date. We alluded to it in the beginning of the call, but international markets have really rallied this year. MSCI EFA up about 20% or just under 20%, compared to the S&P 500 up 6.2%. Now, a lot of that's one, I guess that's the first or the best start to the calendar year in the last 20 years, and outperforming by 13.2% relative to the S&P 500. Most of that, or a lot of that, is driven by a weaker US dollar. And we'll unpack that a little bit more, but it's not just a US dollar story. If we think about markets abroad in local terms, they've looked really good too. MSCI ACWI US, EFA, and EM all outperforming the US on a local basis. So eliminating that US dollar tailwind have outshined the US markets. And there are a number of factors driving that. Economic stimulus and targeted stimulus within China, renewed defense spending in Europe, easing monetary policy in Europe, and just cheaper valuations relative to the US abroad have all driven that strong local market performance. Now let's go back a little bit on the US dollar. Notably, it's declined about 11% year to date, a pretty strong move, all things considered. And with that, and with policy changes, a lot of headlines and questions have been popping up about the status of the US dollar and its reserve, or the US dollar and its reserve status around the world. I think in context and is important here, right? If we think about what the dollar has done over the last 30 or 40 years, you can see that it goes in large and big cycles. Today, it's still above average, right? That yellow line. And you can see higher highs and lower lows. And all throughout, the US dollar has remained that reserve currency around the world. So it's not just a price move. There are other factors more important to that, right? The US dollar is really entrenched in the global financial system. The US economy and financial markets are the deepest and kind of center to everything financially related around the world, right? Foreign exchange, global trade, global FX, all priced in US dollars. Oil, one of the largest traded commodities around the world, all priced in US dollars, right? It takes a lot. It would take a lot to unseat the US dollar within those markets and disruption to move to a different currency. There are also a lot of non-financial factors to think about too. The rule of law in the US and the political system and stability compared to regions around the world. Just our position in the global economy and geopolitical, our military strength, and how that creates just an institutional strength around the world that is supportive of the US dollar, right? You need something that is going to back that reserve currency. And there are not a lot of regions around the world that can do that compared to the US.
So I had an opportunity here as Rob was going through to see a lot of the questions in the chat window. I think we've addressed many of them as we've gone throughout, and we want to be respectful of time here on the 30-minute mark because we know your time is valuable. So, in conclusion, a handful of things: fragility, durability in the age of alpha. The themes in which we enter the year, we think are still very relevant to current portfolios and positioning. How we position portfolios across fixed income, equities, and alternatives, including real assets, hedge funds, and private markets, we do believe still has the very best optimal positioning and what we think is not just for the second half of 2025, which is clearly important, right? But we're not really trading in 6-month increments. We're thinking far longer term. Net impact, right, in today's environment, as we sit here in July and frankly, the remainder of 2025, we don't think it's a time to reach for risk. Part of that is based on those conditions of fragility, right? Ensuring that our allocations are balanced, coming back to that idea of durability, whether a portfolio's kind of been on autopilot and maybe you own a little bit more equity than you have in the past, or you're seeking to take advantage of some of the prices that have come from the success in the US and maybe reallocate capital in a global allocation or across other asset classes. And then this idea of either inflation or age of alpha, right? Those preconditions where we can use certain asset classes. Rob mentioned dynamic bonds. I've mentioned alternatives a handful of times. Those are opportunities that we believe still remain very relevant for 2025 and beyond. So if we didn't get to your question, please feel free to reach out either to your consultant or us. You will find our full mid-year 2025 allocation at the insights section on our website. That contains these slides and many more talking about these key topics. But as always, we appreciate your time and attention over the last 30 minutes. Should you have any other questions or comments, we're always happy to see them. So please reach out. Thanks so much for joining us.